You heard it here first on the Rollup.
In Aave's perspective, the actual lending and borrowing protocol, stablecoins is very core of that. So there's a really good relationship with stablecoin issuers because that's where you get utility in DeFi by accessing yield.
What is the thesis to why securities tokens will overtake multiple crypto assets and stable coins in terms of the greatest asset class on chain?
There's a lot of things denominated in dollars in the financial system that like look like dollars, but they're not real safe dollars.
Welcome back to the Rollup. We are your hosts. I'm Andy.
I'm Robbie, and this is your home to learn from the biggest guests, the brightest minds at the tip of innovation.
Our goal is to help spread the collective knowledge of everyone in our community.
We are breaking crypto out of its echo chamber and taking it to the real world.
Sit back, relax, and enjoy a quick word from some of our awesome partners who make this show possible. The intersection of AI and crypto is moving fast, and soon an agent will be managing your on-chain transactions for you. But without guardrails, it's a disaster waiting to happen. Newton locks agents to your intent with cryptographic proofs and real penalties if they slip. Learn more at Magic Newton on X.
What is going on, guys? Welcome back to the Rollup. Today, we have the pleasure of hosting our stablecoin experts, Sam from Frax and Stani from Aave. These guys know everything that's going on with all of the adoption happening in the stablecoin world. I'm very, very excited for this one. Guys, you're a friend of the show. Welcome back. It's a pleasure to have you guys.
Pleasure to be here.
Thanks for having me here.
Absolutely. I mean, let's just be, brutally honest. Stablecoins are on an absolute tear. I think this is one of the few products in crypto that has found product market fit. We see stablecoin regulation being passed in the House and the Senate. Things are progressing so swiftly. It just seems like there's no resistance, and this is a runaway train. Stablecoins are at 1.1% of all dollars in circulation, and it's just up only from here. How are you guys feeling being in the stablecoin space right now?
You wanna let me
go?
Okay. Let's do it. So I mean, I'm just trying to hold back my excitement. So if it looks like too excited, let me know. I'll tone it down because I'm absolutely like ecstatic. I didn't expect this to be like to this level, even myself. Every report from like Bloomberg, ETF, everything I read in terms of investment reports, everything, it just says the two most incredible industries right now, the hottest industries in the entire planet right now, AI and stablecoins, AI and stablecoins, AI and stablecoins, AI and stablecoins. Just like there's absolutely nothing that matches these two, at least right now. And so it's like really so incredible to finally be at the apex of the thing that you've worked on for years, and the world is finally like meeting you there, right? I think that's an incredible feeling. I know Stani, basically he's like one of the DeFi godfathers, so like he probably already has felt this feeling when you work on DeFi for like years, and then the entire planet meets you there at the top of the mountain, and it's a different feeling. And like it's really cool for me to finally feel it. Stani is even more of a veteran than me because he's felt this incredible feeling. And so you're right in that right now, after Monday, the Genius bill closure, which was the actual most unknown and difficult part. So like the U.S. procedural system, the political and legislative system is very complicated, and so most people that are like observing it don't actually know what the heck is going on. And so it's like a bicameral legislature. There's multiple votes. People are like, oh wait, this can vote again. How the heck is? And then wait, there's another vote now, and all this stuff. The short answer is that now, barring some huge different thing that even Republicans change as a priority, which is very, very unlikely, some form of this and kind of a fusion of the Stable Act or this, which is the House version, will get passed, basically. Like that's why you see all the headlines of like the Senate passes this, but technically there's no such thing as being law when just the Senate passes it, right? So it has to be signed by the president's desk. But this is such a historic thing that I think everyone is beyond ecstatic. There's just I'm personally next week speaking at a conference with Senator Bill Haggerty and Tom Emmer about this exact thing, stablecoins, and all of the things that'll go in effect as soon as the ink is dry. So short answer is I'm absolutely ecstatic. Frax is right there, and can't imagine how cool this feeling was when Aave led this in a DeFi summer.
Yeah.
I think it's a kind of I echo what Sam said, that it's really interesting when you work in a space and and kind of like you don't really expect how far things are going. So in some ways, in back of your head, you always have this idea of this technology and stablecoins and DeFi. It's going to be the backbone of all finance eventually. So it's just a natural way of moving to a new type of financial substrate that enables new types of use cases. And the same way we went from paper to digital and now moving to completely new world. And that progress takes a lot of time. And when we started with Aave and even earlier with Eatland, by that time, there weren't stablecoins actually on Ethereum. So you didn't have this whole concept of stability. And now, a few years later, stablecoins became the main primitive to actually consume liquidity and also extract yield as well. That's really kind of like a understandable form for more of like institutions and mainstream. So I always think that simplicity scales, and that's somewhat applied to crypto as well, because stablecoins are very simple concept to understand. My kind of like the reason why I'm super excited is because it can really change the whole perception of crypto. First of all, whenever mainstream thinks about crypto, it's a lot about speculation. Speculation exchanges, because that's how it's engineered and marketed for a lot of users, because they have to go to an exchange marketplace to purchase an asset that might have very little utility, um, and that's a big problem. But with stablecoins, you actually open a new type of use cases that didn't exist before for mainstream. And I think stability is actually the least interesting one. Stability works really well where you have a very fragile or inefficient financial system that can be, for example, Argentina, across Africa, and some of the countries in Middle East and Asia. But what stablecoins can actually do in the Western world, like Europe and US, where a lot of this legislation is being now passed, is given access to that DeFi opportunity and being able to consume that liquidity and then also being able to consume and extract that yield opportunity as well. And I think that's fundamentally interesting use case. And then what can happen with payments and value distributions without borders. So yeah, I'm really excited about this quite a lot. And of course, when it comes to legislation, a lot of the devil is in the details. What kind of details the legislation has, and that affects the space. So even things are getting regulated, we have to be extremely careful that right type of regulation will pass. And there's still compromises that we have to make.
Yeah. So I think that's a very good point, and we'll dig into the nitty gritty here with regards to the Genius Bill, and this is still remains to be seen how these regulations flush out in the stablecoin world, in the credit markets. For instance, I think a significant value proposition, Stani, that you mentioned, and Sam, you hit on this too, is the extension of the US dollar, and really extending this into markets where currencies are hard to come by. Good currencies are hard to come by. For instance, you mentioned Argentina, some African countries, some countries in the Middle East and Asia, and these are countries that are plagued by hyperinflation, and so they crave the US dollar. They need the US dollar because it is one of the more stable currencies that exists around the world. And so the first step is extending stablecoins into these markets and these jurisdictions. The next step is extending yield opportunities on the US dollar and stablecoins in these jurisdictions. Not only do they now preserve their wealth and their capital by not inflating it away in their native currency, now they're able to earn some stable yield on these currencies as well. And I've heard arguments on either side of the fence with regards to how stablecoins will affect the US dollar's position in the global currency dynamics around the world. I've heard some arguments that say, look, stablecoins are going to threaten the US dollar supremacy around the world. And then, I think all of us here would say, that stablecoins really extend the US dollar position in markets around the world. And so, do you guys have any comments to the pushback that we hear sometimes about, look, stablecoins could actually kind of undermine the US dollar around the world? How would you respond to some of those criticisms?
Yeah, so I'll take this one because the first part about it I think requires some background for everyone even considering the question. I've been in the crypto space for like over a decade now, and like I've seen like I started mining it back in college, like at UCLA, and like before Ethereum and all this stuff. I think when it comes to stable coins, people have to understand there's basically two phases. And like history is classified as before Christ, after Christ, BC, and all this stuff. I like to classify this as there's two phases of stablecoins. One is the original ethos and thesis of like stablecoins was, could we bring like Bitcoin's trustlessness, its non-custodial nature, its everything to a stable unit, right? Something we're familiar with, like the USD. That was like the holy grail. That was kind of the entire ethos of decentralized or algorithmic, even stablecoin. Algorithmic kind of represented this infinitely scalable and contractionary, and like you don't need a bank account to keep it stable. There doesn't have to be a dollar in like a thing redeeming it or anything. It's just this incredibly on-chain amazing thing that's like all the best parts of Bitcoin and Ethereum or whatever, right? And in a stable unit. It turns out that that's not actually the most immaculate design because it doesn't work. It's like an infinite, energy machine. Those things don't exist, right? It goes against the laws of physics or economics, essentially, right? And the industry moved on from that as the immaculate design of like a stable coin. And to be honest, even when the industry was like fixated on that, which is why Terra got super big and then imploded, actually the V1 of Frax, for people that are familiar that watch the Rollup, right? The V1 of Frax was the immaculate design of stablecoin is this hybrid, decentralized, scalable model. And what actually, it turns out, if you're going to peg to a national unit like the USD, the actual immaculate design for that stablecoin is if the entity that issues it, in this case the US government, right, actually points to your thing that you issue and it says that's $1 by decree of law, like fiat, right? By literally decree of the government. And that's how you turn pieces of paper with just pictures of like dead presidents into actual like money, right? By literal decree of fiat, right? Of the state. And so no one really expected that would even be possible. That was like even outside the reach of like, oh, let's get banks to like work with banks or whatever. And so now it's actually seems like it's going to be possible in the next like couple months, which is incredible. And so that's actually also why Frax's new FrxUSD stablecoin and our completely new revamped roadmap that's completely different than how we started. It's still based on stablecoins, obviously. Like with Frax is always a innovative stablecoin protocol and issuer, and now chain developer too with Fraxtal. But it is like we go after the immaculate design, the thing with the trillions of dollars of TAM, and it seems like now going across the arc, like if you're writing the history of stablecoins or like crypto or finance, looking back on it, this is how I would describe it, right? This collective consciousness of realizing you don't have this like fully decentralized, immaculate design that's scalable to like $20 trillion, which is the total amount of USD, actually like the Fed tracks is M1, right? You can't do that. The actual best way to actually have this immaculate design is have the Fed and the US government be like, your digital non-custodial cryptographic token is M1 money. Like that if you could actually do that, that is the most incredible thing in the world. That's Frax's current roadmap with FrxUSD. And I think that when you look at it like that, it becomes really self-obvious, back to your question, that it is not against the interest of the US dollar if you're going to get the US government to actually say that, right?
Yep. Yeah, absolutely. Stani, anything to add?
Yeah, I mean, I do think that the dollar is a very simple instrument of settling transaction in terms of just thinking the mental model, and I do think that the internet didn't really disrupt dollar in any negative way. In fact, it expanded trade in dollar across the world, and I expect the same thing happening because the reach is just higher. And I do agree with what Sam is saying about the scale that we have to think about here, because doing something kind of like in a more decentralized way where we can have a common, let's say, a pointer or like a peg into a new system requires quite significant amount of time and adoption. And I think that's years of work of getting something more universal than dollar. And I would like to see like a more of a universal currency that is more decentralized and has some really fair, equitable rules as well. But for the time being, I think that where we see most of the scale for this technology is simply in terms of scaling it into existing value. Now, what I think will happen over time is that we do have now crypto native assets that are the biggest kind of like asset class on chain. Stablecoins will be the biggest asset class on chain from 2 to 3 years from now, and then from 5 to 7 years, security tokens will be the biggest asset class, even bigger than stablecoins and also crypto native assets combined. So the scale that we're going towards is really important here, and there is definitely a benefit of getting and onboarding these traditional assets as RWAs and reflecting them on chain, and most of them are USD. So I think actually down the line it just strengthens the concept of settling transactions in a value that is dollar, but that's not necessarily the end game of what is the financial system going to look like in the future. This is just a transformation that is going to happen for the next 10 to 15 years or so, where we change the medium where we transact into a new one which has very unique security properties and interoperability properties that enhance the liquidity aspect. But down the line, that just creates more interest towards our ecosystem and to on-chain to actually then build some really future-proof stablecoin primitives and ways to transact value. So now that what's important is to actually like make this transition to happen as fast as possible and as to accelerate it as much as possible. And that's why I'm super excited when I see more kind of traditional financial institutions, fintechs, to actually thinking in realms of stable coins and supporting the space, because that's just additional validation and that actually highlights that there's a change of perception that is happening and high interest at the moment.
Stani, can you've been right multiple times, right? You were right with DeFi, lending and borrowing, significant part of DeFi, maybe the most significant. And now stablecoins has its coming out moment. You know, you're 2 for 2. And now you're saying securities tokens will be the largest asset class on chain, greater than the collective sum of stable coins and crypto assets. Can you explain securities tokens? You mean equities? And we saw Kraken's announcement. Robinhood is coming out with tokenized equities. Is this the securities tokens you mean? And generally, what is the thesis to why securities tokens will overtake multiple crypto assets and stable coins in terms of the greatest asset class on chain?
First of all, I think I'd be more wrong than right. But that being said, I think that the concept of security tokens, or maybe we use the term RWAs, is that it's such a wide spectrum. So it can start from equities, can be publicly traded companies, but it can be also privately traded companies that people don't really have access to as of today, or the access is on a limited group of people and institutions. And it can go all the way to, for example, debt. And we see already T-bills is a really simple example of tokenization of securities that has been valuable when DeFi rates has been lower, for example, to bring that yield on chain. But also over time, we will see progression on the risk curve going just higher on the interest rate interest rate opportunity that exists in traditional finance, and bringing that on chain. So that aspect is quite big and long, like a big wide category. But I also think that it enables a lot of new types of value that kind of exist in the traditional world, but doesn't really find liquidity. And I think the main kind of like output from DeFi is the ability to concentrate a lot of liquidity, make it as interoperable as possible, where opportunities where capital finds opportunities. And if that happens as efficiently as possible, we actually see valuable things coming on chain that were illiquid, but not because they weren't interesting investment opportunities, but because it's actually hard to invest, or it has other types of implications. So that's where I think it's really interesting. And in some ways, you could argue that stablecoins are RWAs. They just don't pay the yield for the end user. The yield might be more B2B from that perspective, but that means just that so much value is outside of the blockchain system that is coming in naturally because of all the value is outside at the moment. So that's where we're going to see a lot of growth.
Absolutely. I think that paints a vivid picture of the value proposition of bringing these assets on chain. It's about turning these into productive assets and tapping into the opportunities that interoperability and composability with a greater financial system provides: yield, liquidity. These are instruments that are seeking liquidity and yield, and they can find it on chain. And so you mentioned treasuries, which I believe are the primary reserve asset of a lot of these stable coins that are issued on behalf of these reserves. Sam, you talked about the talk you're going to have next week in Vegas with Haggerty and others that are writing this legislation. Part of what you had described was kind of what opportunities open up once the ink dries. Could you kind of talk about what are those opportunities? We all kind of understand the stablecoin environment as it exists in the current moment here today. Once the ink dries, what are those new opportunities that open up?
Yeah, for sure. I actually like to explain this because it's pretty much totally different than kind of these regional like stablecoin. Like in the EU, there's Mika. I think in the UAE, there's VARA, the virtual asset like regulatory authority or whatever. And then like Japan has something like some stablecoin license. I think Circle announced they got it like a couple months ago or whatever. And I think the main thing people miss about like Genius is that this is not some like guidance or like some license that you collect in like a region you want to expand to. This is the actual government of the entity that issues the unit everyone pegs to. If you're issuing like EU stablecoins, yeah, you do, this does not, it's not that important to you. This is like a regional license thing, right? But if you're pegging to USD, which is pretty much 95+% of the entire like stablecoin market cap, what the entity that creates USD by pointing at pieces of paper says about your thing is pretty much the root terms, so to speak, in like code lingo, right? Because it is not actually just some like region. I think like actually I love Arthur Hayes. He's always on the Rollup and stuff. But I think I heard him like literally on one of the other ones like last month or something say like, "Oh, I haven't even read Genius. I haven't. It's just for like Americans or blah blah blah." And like whatever. Like we're focusing on the emerging market or whatever. I think Respectfully, that's exactly the opposite. That's wrong, because this is about the USD unit. And so if you are really like realized as a dollar for your cryptographic like token representation, uh, anywhere that accepts dollars, right? Like even EU banks and stuff, right? Is going to be open to accepting this, obviously barring like they need to be able to ping a blockchain. It's in a blockchain ledger instead of a COBOL like old, Swift enabled database. But legally, it's a dollar, right? If you think about euro dollars, those aren't dollars in the US system, right? But dollars in the US system are, by definition, legitimate dollars in the euro system, right? The euro dollars aren't. Otherwise, they'd just be called dollars, right? Like there's a reason it's called euro dollars, to distinguish it from the fact that it's not real dollars, right? And so in like the outside US, dollar intaking, depository, accepting financial systems that basically are like takers, right? They take dollars from the US M1 supply. Anything that's a dollar is fair game. Like you would have to go out of your way specifically to make sure like you don't accept it. Otherwise, it's fungible with other M1 dollars, right? And so, in fact, the other way that I'd like to say this is like the Genius bill. It doesn't turn your stable coin into like a legal stable coin. It turns it into a legal dollar, right? So like if a dollar is legal in a different jurisdiction, just removing the blockchain balance check tech side of things, right? You're fine. You don't need permission to like literally operate in a different jurisdiction or something like that. You're banks literally, like you probably saw, like banks are talking about how to create consortiums to issue their own legal like stable coins, right? Like JP Morgan, Citi, and etc. And like I wish I could actually talk more about it, because we had to sign an NDA, but we actually were talking to like the banks in that list, and they understand all of this stuff, that this is a pretty big deal. And so like with FrxUSD, with whatever payment stablecoins, I assume USDC, Circle's already looking into it. I know Tether for a fact is. Paulo has been in DC. Whenever I wasn't, probably more, way more, right? They know that this is a big deal. It's not like, oh, we're not MiCA compliant. Okay, just delist us on a few of these European exchanges. This is like make or break if you actually issue a USD unit, right? Which is why everyone is there. It's not for like some like photo op or something to pump a token. Tether doesn't have a token, right? Circle doesn't have a token. It's not about that. It's literally about this huge, important like landmark bill that you probably saw on Twitter. People are saying, like, even the people that know, they're like lawyers and all this stuff in the crypto industry. They're like, I don't think this is priced in. Like, this is definitely not priced in yet, and it'll slowly get priced in probably over the coming months as there's more news of like banks issuing legal stable coins. Hopefully FrxUSD, you'll see a lot more news there, and things like that.
So this sort of breaks the momentum, breaks the inertia, and starts to indicate the trajectory of the US dollar and its intertwinement with stable coins. And it's that there are multiple issuers of the dollar, right? So it's not just that, one entity has its finger on the money printer button. Now it's like there's multiple entities that have that button available to them. You mentioned, Sam, like the major banks, JP Morgan, Citi, these guys are exploring this joint venture. And it's exciting to hear that, you had to sign an NDA, because it means you're kind of progressing down some talks with them. Congrats, kudos. And so to explore that train of logic, it's like, okay, well, these guys are now launching, a potential stable coin, right? We had Meta say that, potentially they want to go ahead and launch a stable coin. Maybe Apple, maybe all of these, whether it's financial or tech or CeFi or DeFi, these entities are beginning to explore launching their own stable coin. And all of this is really a form of US dollar, as long as it has the, magic wand that says it's a US dollar, it's compliant, and it really does fall within that category. But it is a change in the system where we had $1, right? And it was issued by one entity, and now there's multiple issuers and multiple entities that are issuing dollars. So in my mind, the natural conclusion of this, like, we trace this slippery slope, and we all end up with, multiple local issuers of US dollars. eventually, what does this turn into when all of these different companies are able to issue the dollar? Like, what are some knock-on effects of that? Because it seems like there's going to be some like economic knock-ons of multiple entities and issuers of the dollar. Does it mean we kind of transition into like a more localized credit market where we can have more issuers kind of issue these loans, extend the supply of dollars? Generally, maybe you guys have thought about this. What do you think are the knock-on effects of multiple issuers of US dollars? Innovating finance, global, institutional, and on-chain. Deep liquidity to drive capital efficiency. Now, maximize yields on institutional-grade liquid staking with METH. Unlock $1 trillion of capital via FBitcoin. All of this secured by Mantle's treasury of billions in stables and ETH capital pools. This entire ecosystem is coordinated by a vast network of seasoned VCs that are aiming to create the next generation of banking and financial technology. This is Mantle.
So I'd love to hear after I say this what Stani thinks about what I'm about to say. But like basically, you're totally right in that there's essentially multiple definitions of dollars, which is why the Fed has the M1, M2, M3 definition, because there's a lot of things denominated in dollars in the financial system that like look like dollars, but they're not real safe dollars, right? And people know that in DeFi, from Terra, from all of the other things that are like dollars, and then they implode and they're no longer dollars the next day, right? And so the important thing I think to focus on here is like the only so the definition of M1 is like money immediately usable in the economy. M1 money is like bank deposit, on-demand bank deposits, like money market funds that are same day convertible to cash in like a bank or into like your Venmo account, and you can use it in the economy every single day easily. And so there's M2, which is more risky, like debts denominated in dollars that are not FDIC insured banks, that aren't any of these things, right? They're more like investments denominated in dollars. And so the most important thing with the Genius Act and payment stablecoins is that for the entire financial history of like the United States, since like basically the early to mid 1800s, when like wildcat banks started to pop up and everything, the only people or entities that could actually make M1 like money were banks, chartered banks that had a very specific way of like, and then more and more regulation obviously happened every single decade, as early as like 2008, right? With new the Sarbanes-Oxley Act and like Basel III and all this stuff. But for the first time, I think, which is why actually some banks, until it really seems like now it's about to pass, were very, very, very against the Genius bill and these acts, because they prefer, and honestly, if I was a bank CEO or like a bank shareholder or like whatever, they prefer their single monopoly on issuing M1 money, right? Which is why the bank lobby is not very fond of this bill, because for the very, very first time in history, some other entities that aren't chartered banks, that don't have to actually do the exact same thing as like the large banks, can come, be nimble, innovate, and actually issue M1 money. Obviously, the rules for it are very, very clear, right? It can only be backed by 2A-7 money market fund, securities, T-bills, Fed reverse repos, certificate of deposits at FDIC insured banks, which are basically as good as money. That's part of the M1 definition of money of the Fed. And so after that, you can issue it, right? You can, and FrxUSD is gunning to be hopefully the first payment stablecoin chartered entity. We'll see, right? Like at least one of the first. And I think that is what you're getting at. And I think that's super, super exciting, because it really is the first time in history. That's why it's super historic. And I'd love to know how Stani's thinking about it.
No, I agree. Like that's the same thing that, when it comes to legislation and these acts, the devil is in the details on what kind of if like intuitively it always feels good that there's some sort of regulatory approval on for example stablecoins, but the main challenge there is that what kind of limitations these acts can actually have. And I'm mostly concerned, obviously, on the innovation aspect. So I've, before building DeFi, I was building fintech, and pretty much at that point when crowdfunding, peer-to-peer lending was a big thing at that time, and regulation followed really quickly in that space. And at some point, it became very difficult to actually compete and create products with a smaller team without having a proper investment into legal resources and actually then sufficient capital. So it is very tricky, and I think that we have really good people from the kind of a crypto space representing and looking after our industry, and that's not the case always when it comes to these types of technology, where you see a lot of innovation happening, but a lot of it goes away, and the innovation opportunity goes away because it gets easily overrated. Partially, I could argue that Mika has some of these challenges on the European side, where Mika establishes some of the rules operating a crypto company, stablecoins, and so forth. But at the same time, the whole legislation was based on a stablecoin like Libra from Facebook, where you use basket of different currencies, and that doesn't even apply, and it ended up still into the actual regulation as of today, without actually putting a lot of attention of what are the stablecoins that are actually used in our space. So that's a really kind of like an angle that I will always be critical of ensuring that nothing really stops building decentralized systems. And by decentralized systems, I mean building resilient infrastructure that just creates better outcomes, like better pricing, better efficiency, more transparency, and just overall better financial system that serves people. So I think that's the kind of point. So I'm overly like positive because so much work has gone into actually ensuring that that innovation opportunity doesn't really disappear.
Yeah. And I think from what I've seen from the outside looking in on this administration, they are thinking about deregulation. And so, Sam, I think to your point, we initially had this monopoly essentially of banks that were part of this inner circle that could issue, and they had charters to issue dollars. And that was part of M1. And despite putting more regulation by passing this Genius Act, we're actually dismantling that monopoly, and we're extending that that inner circle to a broader set of institutions, broader set of entities that are now able to issue. And so ultimately this is favorable regulation, but it actually deregulates the industry a little bit in the sense that now it's more accessible for new decentralized even companies to come in and experiment and innovate. Now,
Yeah, actually,
yeah.
actually, you said, let me just add something there. You said a really good point, because this is how you know this specific regulation, this specific bill is really good, because usually regulation is most often opposed by the small guy, exactly as Stani said, because they have these lack of resources, right? That these big companies do not. And regulation, usually the main thing people say against it is it just makes the monopoly of the incumbents even bigger and harder to pierce, and everything. The fact that you can see how anti the banking lobby and the traditional financial system have been against this specific legislation is proof, right? Like that's empirical proof that this is one of the few legislation and regulations that actually opens the playing field. That ideally, that's what regulation should do, right? They should flatten the playing field, allow for more innovation, exactly as Stani said, and then also encourage and excite entrepreneurs and innovators to get into a specific place, while creating clear-cut rules so that everyone has to obey those actual rules. And you don't have many examples of those, right? If I were to tell you, hey, like what's the last thing that, of example that like this exact dynamic happened where entrepreneurs are like, yes, more regulation. And then like the incumbents are like, no, not more regulation. There isn't many. That's how you know that this is a very, very good thing in the space, because it does the exact opposite of what people characterize, usual regulation as.
Yep, absolutely. Yeah. So I think as we see more issuers enter the playing field and we start to see more stable coins, I'm curious as to incumbents in the stablecoin field, how you guys are going to sort of maneuver and position around these newer stable coins and these new issuers, right? We mentioned some major banks that are coming into the stablecoin game. For instance, how do you guys see Go interacting with a new, bank issued stablecoin, or Frax interacting with like a meta stablecoin? How do you guys see those stablecoins interacting with one another? Are they complementary, or ultimately is there a new robust competitive landscape that forms? How do you guys see it?
Yeah, I don't see stablecoins competitive at all. Like I actually see them in some ways as like payment trails. It sounds a little bit weird, but like if someone uses, let's say, Go or USDC, they basically choose a payment trail, and the same way I think will apply to pretty much all the stablecoins. So in Aave's perspective, the actual lending and borrowing protocol, stablecoins is very core of that. So there's a really good relationship with stablecoin issuers, because that's where you get utility in DeFi by accessing yield and consumption as well. And that creates also not just yield and consumption, but also long-term holding. So roughly over half of the suppliers in the Aave protocol are holding their stable coins in Aave over 6 months, which is good for stablecoin issuers. And from Go perspective, Go is obviously backed by mainly the native crypto collateral like ETH and ETH derivatives, or wrap Bitcoin and Bitcoin derivatives. But at the same time, Go can be minted against these other stable coins to get scalability effects and other properties. So for example, the stability modules within the Aave ecosystem for Go, like GSMs, that we call them, you have one with USDT and one with USDC, and we could see more similar in the future. So because Go has this facilitator functionality where a facilitator has a bucket that can actually mint Go against collateral, we'll see this as a way of actually allowing more collaterals. Then it's up to, obviously, then up to the Aave DAO to decide what kind of RWA or like a stablecoin collateral could actually be backing Go. So that's the kind of like an angle that I would say from Go's perspective.
Yeah, I think I totally agree with Stani in the sense that like liquidity begets liquidity. Like like economics is positive sum. Sometimes it is negative sum, but you don't necessarily have to take other people's piece of the pie, right? You can grow the entire pie, which is why I keep bringing up the 20 trillion M1 money that's basically up for grabs to being converted to stable coins, whether it's whether it's FrxUSD or USDC or a bank stablecoin and stuff. We've only converted about 1% of the digital dollars of like the analog Web 2 world into the Web 3 digital dollars, right? And so I think like the most important thing here is to consider like everything needs a foundational like digital dollar, especially hopefully now a legal one. So the ones that are anointed by like the US government that issues dollars, if we're going to be doing business in USD on chain or off chain, right? To be a dollar. And so FrxUSDs, for example, only like about 3 months old. So we're actually going through the Aave listing and ARC-FC, I think, process is what it's called. And maybe later will be hopefully a stability module mint for Go, because it's fully redeemable. Hopefully it's legal tender, issued by Frax and everything. So I think that's a really good example by itself of how it's symbiotic, right? And the interesting thing is the places where digital dollars like FrxUSD, USDC, USDT cannot compete, which is like higher yield than the risk-free rate. Like there's basically reward programs that like digital dollars can do outside of their token, right? The token has to be $1, always $1, and mint redeemable for $1. But like you see Coinbase, there's a USDC earn program. We also will have something similar called FraxNet, where people like basically sign up for a fintech account that they can connect all their Web2 stuff, banks, brokerages, all this stuff, mint FrxUSD, and they custody it. They just connect their Web3 wallet, right? And then they can get the risk-free yield, right? Like for the FrxUSD that they hold, right, through the FraxNet fintech and banking app. There will be those things, right? And you already see it with like USDC and Coinbase, right? This earn system. But by definition, those can only ever go as high as the risk-free rate on short-term T-bills or registered security money market funds, right? That's where Go, that's where Athena, that's where Maker or Sky, right, comes in, where you're able to actually have things that establish themselves as, the premier kind of like M2 that everyone wants to save and use on chain, right? On top of the legal digital dollars, and that's just positive sum, right? That increases liquidity and usage of the underlying digital dollars, and then those digital dollars can't necessarily compete with the higher yields and usefulness inside of DeFi on the decentralized stack and the decentralized yields. So it's pretty symbiotic, and one wouldn't pretty much exist without the other, right?
Man, I'm curious, like, I'm just stoked because we said 1.1% of stable coins, or 1.1% of the US dollar in circulation of that M1 supply, right? We're only breaking the surface. As more and more liquidity comes on chain, it tends to proliferate outwards from there. And so that finds its way onto Aave. It finds its way into, money markets as a whole in DeFi, finds its way into, these different trading venues and DeFi venues. And this is, the industry that's been building for this sort of liquidity generation moment. So I'm extremely excited. And you guys both have been making so many innovations to your own protocols, basically getting prepared, right? So that when there's institutions that are looking at these protocols, it passes that due diligence. Sam, you guys are transitioning to an L1, right? From Fractal the L2 to an L1. Is part of that like getting prepared for this institutional wave? What went through that thought process, and how might things change on the L1 as you see this onslaught of liquidity?
Yeah, definitely. It was a pretty hard decision, both in terms of like both technical, but also like structuring, because we've upgraded the old FXS token, which is like runs like the governance token, to like an L1 gas and unit of account token. We've just renamed that Frax share token to just Frax. Because the new stablecoin is FrxUSD, so it's totally different. It's a payment stablecoin. These two tokens are completely separate now, and the L1 token of Fractal is just the Frax, scarce commodity asset. It's a gas token, and obviously also you could stake it to get all of the income of like the chain and the Frax ecosystem, etc. But I think actually Stani mentioned Libra. That's actually the simple one-liner. Is like Frax is executing the Libra roadmap at the right place and right time, right? Because there's this L1, and it actually is the issuance and settlement hub of a stablecoin for us, FrxUSD, right? And then obviously it's issued on a lot of ledgers, because if it's good money, it should be used on a lot of places. And then the message passing system goes through the Fractal L1. So one way you can think about it is like our version of CCTP is a chain. So like if CCTP was like a fully programmable chain, right? Circle's message passing system, where people take USDC one-to-one to different chains. We're also on 15, I think 14, 15 different chains like Solana, Ethereum, L2s, all this stuff. And then it goes through Fractal chain, right? And so if you run like a validator and all this stuff, which we're actually, the next hard fork will allow that. The first one right now, earlier a few weeks ago, changed the FXS token to Frax, like the L1 gas token, update by update. I think this Libra vision is like really interesting, because you have this chain, right? This L1 that is specifically made to accomplish a very, very large TAM vision, right? For us, it's digital dollars, it's payments, stable coins, right? You kind of have the same concept with Hyperliquid, right? Hyperliquid is an L1, and the goal is to establish this system where it is the premier perps and trading menu, and then the next layer, right, like Hyper EVM, people can build because it's essentially a programmable perps and high performance engine, right? And so Fractal is also a high performance EVM, right? And the goal is using it for payments and this enshrined digital dollar. And I think you'll see this structure of L1 with killer, multi-trillion TAM fused into accomplishing this mission a lot more. I think Libra was the original one. I think Frax with Fractal and FrxUSD is like the second one, or maybe you could say Hyperliquid and like perps and trading is the second one, and like we're the third one.
Nice. And so you guys have gone the L1 route. Stani, you guys launched V4, and this is continuing to develop. And there's some really exciting innovations there in terms of the Aave architecture. One of those is this unified liquidity layer, and it creates sort of these adaptations to different modules. Why did you guys choose this path at Aave for this unified liquidity layer versus doing something like your own L2 or your own L1? What made this architecture and this design choice the right one for Aave?
Yeah, quick correction that we haven't yet launched V4, although I was hoping for it. But the proposal to build V4 passed last year, and we're coming to an actually last cycle for the development. And the main kind of like idea for us was to figure out how do we, like, if all value will come on chain, how do we actually are able to segregate the risk of different types of collateral types and markets without actually creating liquidity segregation challenges, because the liquidity concentration is quite important, because that's how you get scale. And the Aave V4 architecture includes a concept of liquidity hubs and liquidity spokes, and that allows you to actually create spokes that have different kinds of assets as a collateral and borrowing configurations like risk parameters. So you can have one spoke that has more conservative assets, and then another spoke that has basically RWA assets, and liquidity hubs are where the actually liquidity is stored. So you always come as a user by consuming one of these spokes, depending what's your intention to supply or borrow. But then the liquidity hub acts as a kind of like a central bank that can give credit lines to these liquidity spokes. And that way, whenever there's some sort of a new innovation that we want to bootstrap quickly, or let's say tomorrow Sam comes up with a very interesting innovation that he wants to utilize in Aave, he can just permissionlessly create a spoke, and then with one transaction request a credit line as a seed liquidity from the liquidity hub into the spoke. And this just showcases that we don't really understand and know what the future will hold and what kind of innovation and assets whatnot, but there's going to be a diversity there, and this allows users to actually ensure that they're able to enter into the system from one point, which is one of the benefits of Aave, that you don't have segregation of different markets, and you don't get confused of for example, borrowing experience where you have different types of markets and you don't know what to do as a user. So the UX is simplified for the suppliers and the borrowers, but still there's a way to actually choose your and position yourself in the risk curve, and I think that's really valuable. And there's a bunch of features on V4 that makes it really exciting, like the risk premiums, where we want to price accordingly and accurately each asset's borrowing costs based on the collateral or collateral composition. So if you supply very lean collateral into the Aave protocol and you borrow USDC, you're going to pay very lean rate, basically just the base rate. But if your collateral composition is more complicated, then you're paying that base rate plus a risk premium. And that way, all the users, they don't basically have to pay for a premium of users that bring more risk into the system. And this creates more accurate pricing for lending and borrowing. But yeah, I could go on and on about V4, and there's a whole proposal about it.
This is actually great because I'm gonna use this time to actually pitch Stani one of the innovations that he would like that I actually have thought of, and gonna do it like in front of everyone because I think that it's actually really good Aave V4 demonstration of like I haven't actually ever said this to him, but like one of the things I was actually thinking of Stani was like just like how FrxUSD is just gonna be like legal digital dollars and fully redeemable. We're going to have this rewards program in our fintech app called FraxNet. And anyone can earn the full yield rewards by holding FrxUSD in their non-custodial wallet. One of the things I was thinking of is we can actually do a rewards program that deposits FrxUSD in Aave. So we can actually, instead of, like Coinbase does USDC earn, if you hold your USDC in Coinbase's centralized exchange. Now imagine a legal digital dollar that's redeemable like FrxUSD, and our earn program is actually you deposit it in Aave, so that you also get the actual yield, right? Like from whatever borrowers are like paying, right? Because they borrow your FrxUSD, they can either swap it to USDC or redeem it or whatever, because it's like a digital dollar. But then you also earn the entire risk-free yield as like a Frax Earn program, right? And so that's a very powerful thing in that you bring digital dollars to Aave and further make it the risk-free yield earning venue because it's already seen as the place in DeFi that's basically as close to risk-free as possible. But in traditional finance, there is literally a risk-free yield, which is like the short-term overnight rate of like the Federal Reserve or short-term T-bills. What if we combine those together and do a huge FrxUSD and Aave partnership? That's one thing that I was like thinking of.
Yeah, and I like the idea, and that showcases the kind of like composability that can be created even in existing the V4 or sort of V3 of Aave, especially with V4. And Sam has had like a really exciting ideas. I think he's like continuously innovating and coming out with really cool things.
You heard it here first on the Rollup.
I love it. The Rollup breaking news. You guys will soon see Sam and Stani on the Rollup TV breaking more news coming at you live. Guys, I think that's a great place to wrap. This was phenomenal. It was a lot of fun. We we have partnerships in the making, and certainly learned a lot about stablecoins, the Genius Act, and everything that's coming down the pipeline in terms of stablecoin regulation, as well as new stablecoins launching. Guys, just again, congrats on all of the great work leading up to this point. It's tremendous to see pioneers in an industry and now the industry get adoption. So again, thank you so much for sharing the time with the Rollup here.
Thank you so much.
Thanks for having us.